think, act, and prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show, where we think, act, and prosper. Today we're going to talk about the Federal Reserve and what Powell is saying on what they're going to do with the interest rates. So I'm going to go ahead and screen share this article from Yahoo Finance, which says that Fed Chairman Powell, we should have moved earlier. So they're using the quotes as in Powell admits that they should have moved earlier. So this is very concerning because the Fed came out last year saying that inflation was transitory. They came out saying that they had it under control and that the supply chain disruptions were going to fix themselves. And then now we're in this situation where we have 7.5% inflation, according to the government, as George Gammon may say, and we're experiencing the price growth of a lot of things. We're seeing our dollars being devalued. So that's what inflation is. The dollar's losing so much value because the money supply has increased so much. You can look at charts of the money supply and see how much money has been created in the last 3 years. I mean, since the pandemic started, we created a lot of money. The Federal Reserve created a lot of money. We spent a lot of fiscal stimulus. The Federal Reserve was buying government bonds. So we created a lot of money in the last 2 to 3 years. And so we're going to go ahead and get into this article. So as we can see, it says the Federal Reserve's top figure, who is Jerome Powell, said Thursday that the central bank should have acted sooner to pull back its pandemic-era stimulus to get ahead of rising inflation. Fed Chairman Powell told the Senate Banking Committee that with the prices increasing at the fastest clip since 1982, easy money policies from the Fed combined with longer than expected supply chain snacks appear to be behind inflation. He says, hindsight says we should have moved earlier, Powell said Thursday, adding that we're going to use our tools and we're going to get this done. When inflation began popping in early 2021, the Fed brushed the figures off as transitory and hoped that supply chains would alleviate and slow further price increases. So this is crazy because, we see that Jerome Powell is saying that, we thought it was going to be transitory, all these different things. I was talking to you all on this channel saying that it's not going to be transitory. We created way too much money in the system and we can't just do that. Like whenever you put up anything that is scarce things hold value. That's why you see things like gold and Bitcoin holding value. That's why you see things like when you have these trading card frenzies, like I think it was a Mickey Mantle card went for $1 million because it's so rare. So things that are rare hold value. However, when you create so much currency units, you begin to devalue the currency and you see inflation because the currency depreciates compared to the goods and services in the economy. And they gave out a lot of stimulus. They gave out PPP loans. We gave out stimulus checks. We gave out child tax credits, a lot of things. I mean, some people probably pocketed some of that money for themselves, and we created a lot of money in the system. And now we're starting to see us pay for that. We're starting to see that inflation's coming back to bite us, and we're paying for that. And this isn't just a trend that's just now happening. We've been creating oversupply of money for a long time. However, 2020 definitely was a different scenario, and we created the most we've ever seen in a while. So Powell talks about rate hikes. He talks about the Fed is going to raise interest rates. He's going to raise, they're going to raise about 25 basis points, which is 0.25% to start it off. And so he then says that the Fed itself is projecting that the economy can withstand short-term interest rates between 2 and 2.5%. And so Powell and the Fed is looking at raising interest rates. We've seen what this does to the growth stocks. We've seen that just them talking about it has caused a lot of fear in the market. The market may be pricing in some of this right now, but they're planning on raising these interest rates. So we're seeing that the mortgages are actually going up. So the mortgage rates are going up so people can afford less house for more money. So they're paying a higher monthly payment and they can afford less house than they could before. So when I say less house, that means that they can only afford smaller homes. And so that's what pretty much higher interest rates mean. So we're starting to see that actually play out in the housing market and with the mortgage rates. And then the Fed talks about the balance sheet. So the balance sheet is ballooned to 9 trillion. So this is very concerning because the Fed has usually kept its balance sheet under control for the most part. I mean, it was at about 4 trillion before the pandemic. So now it's at 9 trillion. So that's just concerning itself, that how fast these debts and things are growing and how fast we're creating money out of thin air. And so the Fed is talking about tightening its balance sheet. So Powell actually did this in 2018. The stock market took a real crazy deep dive when Powell started raising interest rates and tightening the balance sheet. And so what do we think is going to happen now? And, you know, we got a lot of things going on with Ukraine. We got a lot of things going on with Russia. The Fed is in a tight spot. I mean, they're in a pickle between a rock and a hard place. And I don't think that this interest rate hike thing is going to last too long because, I mean, you already have President Joe Biden coming out saying that he wants to help fund Ukraine and he wants the taxpayers' dollars to go support Ukraine and all these different things with billions of dollars. That billions of dollars have to come from somewhere. Where's it going to come from? Are you and I paying more taxes? We're paying about the same amount of taxes, even though they are coming after us in different ways. We're paying about the same amount. It's going to come from the Fed. The Fed is going to have to finance these things. So they're going to pretend like they're going to fight inflation, like they're in a position to be able to fight inflation. I mean, Powell said that we're going to use our tools. So when you're thinking about that, it's like, okay, well, what tools do you have? I mean, in the 1980s, Paul Volcker was able to raise interest rates, let the market raise interest rates so high to where inflation was killed off. And at that time, we had less than 5 trillion in debt. Now we have over $30 trillion in debt. So if we raise interest rates, that means that the government is at risk of default. That means that the government has to pay more interest on $30 trillion of debt instead of less than 5 trillion when Volcker was the Federal Reserve chair. So what do you guys think about this? What do you guys think that the Fed is going to do? Do you think they're in a tight spot? Do you think they're going to let inflation run hot? History shows that governments that run big deficits have to let inflation run hot to kill the debt. So I think that we're in an inflationary decade and we will see what the Fed is able to do. But the Fed may try to raise interest rates until something in the market breaks or something just drastically happens and people push back on it. So what do you all think is going to happen? Hit the like, hit the subscribe button, drop your comment below. What do you think? And I appreciate y'all until we see each other next time.